Have you ever found yourself at a loss for losing trading opportunities because you fell asleep? What's the difference between a market order and a pending order? And how do you safeguard profits with exit orders? Hello friends, today we're here to answer all these questions and more. But before we jump into this, if you haven't had a chance to catch up on our previous lessons, I highly recommend you give them a watch. They'll provide a solid foundation and complement what we're about to learn today. Now with that said, let's dive right into our lesson. Let's understand the term orders first. Orders are, in essence, the precise instructions that traders convey to their brokers. These instructions lay out the exact volume and price at which they want to buy or sell a particular trading instrument. Orders are of three types. Number one, market orders. Number two, pending orders. And number three, exit orders. First up, let's discuss market orders. These are the simplest and most common order types in Forex trading. Market orders serve as the preferred method when you're ready to swiftly engage in the purchase or sale of a trading instrument, such as a currency pair, right at its present market price. Market orders are a bit like Tinder swipes. You never really know what you're getting, and you hope that it won't end in regret. Moving on, so what is their primary purpose? Well, to execute a trade in the blink of an eye, ensuring it gets filled at the exact market rate. Market orders are all about speed and efficiency, making them perfect for traders who prioritize instant entry or exit from a position. For example, let's say you're watching the Euro-USD pair and you see a sudden spike in its value. Using a market order, you can quickly jump into the trade to seize that opportunity. Market orders are ideal when you need to act fast and don't want to miss a trading opportunity. Next up, we have pending orders. These are a bit more complex, but incredibly useful. Pending orders, as the name suggests, are orders that you set in advance. They only get executed when certain conditions are met. These orders are like hibernating bears. They wait for the perfect moment in the future to wake up and execute their mission. Trading with pending orders is like writing a letter to Santa Claus. You list your wishes and hope the market acts as your magical gift giver. But here's the catch, they're not guaranteed to execute. If the price of the instrument never reaches the specific level you've set, the order simply remains in a slumber. Pending orders are of four types. Number one, buy limit order. Number two, sell limit order. Number three, buy stop order. Number four, sell stop order. Let's take a look at these four types. So let's begin with the buy limit order. The buy limit order is placed below the market ask price, anticipating that the price will drop to that level before going up. It's a strategic way to enter a trade at a favorable price. It'd be like telling your date, I'm only gonna pay for dinner if it's 50% off. If not, I'll just go home hungry. Imagine Euro-USD is trading at an ask price of $1.1000. You believe it'll dip to $1.0950, and that's where you want to enter the trade. So you set your buy limit at $1.0950. If the ask price falls to $1.0950 or lower, your order gets triggered and you're in the trade. But if the market doesn't take that dip, your order remains untouched. So why do traders use buy limit orders? Buy limit orders in trading are like saying, I'm ready for a relationship, but only if it's a low maintenance one. I need that discount. Well, the purpose is very simple. Traders utilize these orders when they anticipate that the price of an instrument will touch its support level before bouncing back up. The buy limit is set at the support level so that when the price begins its rally, the trade can be closed at a higher price, capturing those sought-after profits. Now, next in line is sell limit order. A sell limit order is placed above the market price, specifying the bid price at which you want to enter a sell trade. Here's how it unfolds. When the market price rises and reaches your set limit price or goes even higher, the pending order is triggered and a sell trade is initiated. However, if the market doesn't make that rally, your order remains in standby mode. Sell limit orders are a trader's way of saying, I'm not settling for just any price. I have standards, and they are non-negotiable. Let's break this down with an example. Imagine Euro USD is currently trading at a bid price of $1.1000 and you're eyeing a sell limit at $1.1050. If the bid price rises to $1.1050 or higher, your order is automatically executed. But if the bid price doesn't quite reach that level, your order stays put. Why do traders use sell limit orders? Well, the purpose is quite strategic actually. They employ these orders when they anticipate that the price of an instrument will hit its resistance level before resuming a downward movement. By setting the sell limit at this resistance level, they aim to close the trade at a lower price when the price takes a dive, capturing profits along the way. Now let's move on to buy stop order. With a buy stop order, you set it above the market price, specifying the ask price at which you want to enter a buy trade. Here's the deal. When the market price takes off and reaches your set limit price or goes even higher, the pending order is triggered and a buy trade takes flight. But if the market doesn't take that upward trajectory, your order remains on the launch pad, ready for another opportunity. Using buy-stop orders in Forex is like having a maybe button for your trades. I'll buy if the stars align, the planets converge, and I get a feeling. Let's make this crystal clear with an example. Imagine Euro USD is trading at an ask price of $1.1000 and you're betting that it'll keep soaring once it conquers the resistance level at $1.1100. So you place your buy stop at an ask price of $1.1100. If the ask price ascends to $1.1100 or higher, your order takes off automatically. But if your prediction doesn't align with the market's movement, your order stays grounded. Why do traders opt for buy stop orders? The purpose is clear. They use these orders when they anticipate that the market price will continue to rise after it breaks through a significant resistance level. It's like waiting for your date to make the first move. I'll buy, but only if the market takes me out for dinner. The buy stop is strategically placed at this resistance level with the aim of closing the trade at a higher price once the price rises above this pivotal point, all while pocketing those desirable profits. Moving on to sell stop order. With a sell stop order, you place it below the market price, specifying the bid price at which you aim to enter a sell trade. Here's the drill. When the market price takes a dive and reaches your predetermined limit price or goes even lower, the pending order springs into action and a sell trade is initiated. However, if the market doesn't take that downward plunge, your order remains in standby mode. Sell stop orders in Forex are like a high stakes game of catch me if you can. I'll sell, but only if you're fast enough to catch me at the right price. Let's clarify this with an example. Imagine Euro USD is trading at a bid price of $1.1000 and you're anticipating a significant drop once it breaches the $1.0900 support level. So you place your sell stop at a bid price of $1.0900. If the bid price falls to $1.0900 or lower, your order is automatically executed. But again, if your market prediction doesn't quite match reality, your safety net remains unfurled. So why do traders opt for sell stop orders? The purpose is crystal clear. They employ these orders when they foresee the market price continuing its descent after encountering a significant support level, marking a bearish trend. The sell stop is strategically positioned at this support level with the aim of closing the trade at a lower price when the price embarks on its downward journey, all while securing those sought-after profits. Now that we've covered pending orders, let's explore the final category, exit orders. Exit orders are crucial for managing your risk and locking in profits. Exit orders are preset instructions that traders use to close a trade at a specific price level in the future. They're your secret weapon for automating those exit strategies, ensuring that you can make a smooth exit even if you've entered a trade at an unfavorable price. Why do traders use exit orders in Forex? Well, it's like saying, I'm ready to break up, but only if it's done on my terms, with a parting gift. Exit orders are of three types. First, take profit, TP orders. Second, stop loss, SL orders. Third, stop orders. Take profit orders, often abbreviated as TP orders, are instructions that traders set to automatically close a position at a specific price level, effectively locking in a predetermined profit. Now, let's get to the heart of it. Well, on a serious note, their primary mission is to secure gains. When a trade reaches the predetermined take profit price, the order springs into action, ensuring that profits are realized before the market has a chance to reverse. Take profit orders are the secret sauce for disciplined traders who aim to capitalize on winning trades while minimizing the emotional roller coaster of trading decisions. Why do traders use take profit orders in Forex? It's like saying, I've found the treasure and I'm cashing in before the map burns. In the case of a sell trade, take profit is set at a price lower than the market ask price. When the take profit is triggered, the trade gracefully exits at the assigned ask price or lower. For instance, if the current ask price stands at $1.1000, you could set your take profit order at $1.0900 to secure your gains if the price moves in favor of your trade. Conversely, in a buy trade, the take profit is set at a higher price than the market bid price. When the take profit is triggered, the trade closes at the assigned bid price or even higher. For example, if the current bid price is at $1.1000, you might place your take profit order at $1.1100 to ensure you lock in your gains if the price moves in your trade's favor. And there you have it, the magic of take profit TP orders, your safeguard for securing profits no matter the direction of the trade. Next up in line, we have stop loss order. SL orders, or stop loss orders, are your strategic instructions to automatically close a position at a specific price level. They serve as your financial safety net, ensuring that losses are contained within acceptable limits. Stop loss orders are the trading version of, I've had enough, I'll cut my losses and leave the party before it gets too wild. So why are stop loss orders crucial for traders? They play a vital role in risk management. Consider them your emergency exit plan. If a trade starts going south, stop loss orders act as the lifeguard, ensuring the trade is swiftly exited before losses spiral out of control. Traders use stop loss orders to define the level of risk they find acceptable, effectively safeguarding their capital from significant downturns in the market. In the case of a buy trade, the stop loss order is set at a price lower than the market bid price. When the stop loss is triggered, the trade closes at the assigned stop price or lower. Let's illustrate this with an example. Imagine a trader opens a buy trade of EUR/USD at $1.08500 with the market bid price hovering at $1.08480. To protect against potential losses, if the price goes against them, the trader places a stop loss order at $1.08400. If the market price reaches the assigned stop loss price or lower, the stop loss is triggered. So let's say the price goes down and the stop loss order is executed, closing the trade at $1.08300. However, the market continues to drop, eventually reaching $1.08100. While the stop loss order couldn't protect the trader entirely, it limited the loss to much less than it could have been without it. In the case of a sell trade, the stop loss order is set at a price higher than the market ask price. When the stop loss is triggered, the trade closes at the assigned stop price or higher. For example, if the current ask price is at $1.08600, the stop loss order can be placed at any price higher than the current ask price to ensure the trade closes within the set limits. Lastly, we have trailing stop orders. These orders are dynamic and move with the market, adjusting your exit point as the trade moves in your favor. It's like having a smart stop loss. So why do traders use trailing stop orders in Forex? Well, this one is like saying, I'm gonna keep chasing the bus and I'm gonna keep changing my route to keep the chase on. Well, on a serious note, these orders are designed to maximize profits during strong trends. They're your secret weapon for locking in profits while allowing winning trades to flourish. As the market moves in your desired direction, the stop loss level is adjusted, ensuring that even if the market reverses, you can exit the trade with gains already secured. But how does a trailing stop order actually work? Let's say you buy one contract of S&P 500 at $4,500. You want to protect your position from a large downward move, but also lock in some profits if the price rises. You decide to use a fixed step trailing stop of 20 pips, which means your stop loss order will move up 20 pips every time the price moves up 20 pips in your favor. Now your trailing stop is activated and will follow the price movement. Here are some possible scenarios of how your trailing stop will work. If the price drops to 4,480, your stop loss order will remain at 4,480, which is 20 pips below your entry price. But here's the genius part. If the price rises, the trailing stop rises with it, staying 20 pips below the market price. And here's where it gets really exciting. If the price rises to 4,540, your stop loss order will move up to 4,520, which is 20 pips below the current price. You'll be able to sell and close the trade at a price more than what you paid for, locking in the gains you captured. So there you have it, traders. We've covered the essential types of orders in Forex trading: market orders, pending orders, and exit orders. If you found this video helpful, please hit the like button, share it, and subscribe for more exciting tutorials. And as always, feel free to leave your questions and comments below. We'll see you in the next video.